From the morning reading, the Nasdaq, another new all-time closing high. Dow Jones, new intraday high. Breadth, compared to the prior session, strengthened as decliners led 1617 to 1375 on the New York Stock Exchange and led 1645 to 1174 on the Nasdaq. Sectors are canceling each other out. The average correlation between the S&P and its major sectors has dropped to an extremely low level, part of the reason why volatility has been low. Correlations tend to rise when investors get nervous. The recent declines in correlations over the past year is only one precedent in 20 years from the year 2000. Going back to 1928, it has tended to lead to weakness. Volume was heavily skewed to the downside on Tuesday. When stocks rise and we see a funky breadth reading on the New York Stock Exchange, it's usually because bonds got clobbered or small caps suffered a big decline. Neither was the case on Tuesday, and yet the up volume ratio on the New York Stock Exchange was only 35%, an astonishing low reading that has only a handful of precedents in 50 years, all of which led to a decline in stocks over the next 2 months. Money is leaving consumer staples. An average of $335 million per day has left the XLP fund over the past 3 days. The only other times the 3-day average exceeded a $300 million outflow were June 24, 2013, February 4, 2014, and July 31, 2014. Stocks rallied strongly over the next month each time. Shares outstanding are also near the lowest in 2.5 years. Fund flows are not always a consistent contrary indicator, but those previous extremes were notable. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:14 a.m. Mountain Time, and I'm recording this in preparation for the market day of February the 8th, 2017. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report. And first off, let me just give a little bit of a housekeeping note. So there'll be no market preview for the next several sessions, Thursday morning, Friday morning, and Monday morning. Next 3 sessions, no new market preview. I'm going to be in some backcountry areas where there's no reliable internet connection, so there'll be nothing to be produced the next 3 days. Okay, so in the morning report, at the time of this cut, we've got a little bit of a mixed picture on the 4 U.S. broad-based indices. The S&P futures and the Russell futures are down just below scratch. NASDAQ right on scratch, and the Dow also, frankly, right on scratch. Crude oil is down about 0.2%, euros down about 0.33%, long bonds up about 0.33%, and gold up about 0.4%. And overseas action, looks like everybody's open. In Asia, China up about 0.4%, Hong Kong up about 0.2%, Japan up about 0.5%. In Europe, we got Germany at scratch, as is the United Kingdom. And macroeconomic reports of the United States for today of note, we had the weekly crude oil inventories, a 10-year bond, and that looks to be about it. Looking forward to tomorrow, we had the weekly unemployment claims, nat gas storage, a 30-year bond auction, FOMC member Evans speaking. So some moderate activity here in the next couple days, including regular weekly reports. In terms of current volatility, short-term VIX down below a 10, 9.47, skew just above the 130 threshold, so still in cautionary warning status. IV percentiles, the S&P an 11, the Russell a 9, the NASDAQ a 7, and the Dow a 17. No standard deviation size moves were put in on any of the 4 broad-based indices yesterday on a close-to-close basis. Let's go ahead and take a look at the charts. And the S&P futures yesterday were the picture of sideways action. Nothing of consequence was achieved yesterday in the S&P futures. In terms of the Dow futures, we also had, well, a little bit of something interesting. You had an intraday high, but it closed fairly well off from that. And, you know, I don't see in the context of this, all this sideways action, this being, you know, anything significant. So I would say we just continue with the sideways action with the Dow as well. NASDAQ was a little different. NASDAQ also had an intraday high, but also closed at a new high. So two things of note there. So the bullishness continues in the NASDAQ. Let's see just who might be driving that thus far. Look at this Apple. Apple certainly is a big part. Apple's closing in on its all-time high, which was around the 134 area. So Apple continues to be on a tear. So certainly that's part of what contributes to the NASDAQ move, as Apple is a very big component. Google had an up day, but still has room to go to get back to its all-time high. It had an intraday all-time high on the day after earnings, but then fell off sharply from there. Let's see, Facebook. Well, Facebook's been playing around near the all-time highs. Not particularly significant move yesterday. Netflix had a new all-time high yesterday. So there's your Apple and your Netflix. Certainly are contributing to the effort. And I'm missing somebody. Let's see. Apple, Google, Netflix. Can't think of who I'm missing. But anyhow, bottom line is some of these big components certainly were performing well for the NASDAQ yesterday. Let's go ahead and take a look at the Russell. Russell, again, a model of sideways action. Nothing of note yesterday. Smack in the middle of neutral, right in the cloud. It is as neutral in its posture as it can possibly get. In other markets, crude oil. Crude oil had a bit of a breakdown yesterday. And, you know, certainly closed below the recent short-term action, though it's still within the, you know, the general area of the total action of late. But still, I would still put this as something a little bit of a significance. We probably had a little bit of a shelf of support that was just above where it closed. So kind of an interesting move there. And then gold. Gold continues to build on this bullish breakout. This cloud breakout now is starting to move away from the cloud. So we'll continue to watch that. Gold seems to be the only market that wants to trend of late. Bonds also were up, but they're also locked in the cloud and pretty much in a sideways consolidation pattern in recent weeks. The dollar had a bit of a move up yesterday, but is also in the cloud, so relatively neutral posture. And let's see, the volatility. Volatility continues to be exceptionally low. So when you put all this together, you know, there's not much change from yesterday. Gold seems to be the only market that's doing anything really significant consistently in recent sessions, though crude oil had a little bit of a move yesterday, and we also have to give a nod to the NASDAQ with the big moves by Apple and some of the other key components. Okay, I think that's enough on the charts given how quiet they are. Let's go ahead and go to the daily report. We still have a very weak market phase 5 indication. So in our intermediate term phase opinion, a little bit of a warning, but as weak a warning as you can get. And the Three market timing signals, no changes from yesterday. Confirmed uptrend, bullish for the first signal. GMI index did slide one notch to a 5 out of 6, but that buy signal is still in place since 11:10, so that's bullish. And the stock charts decision point scoreboard still remains in a mixed signal posture, with the short term and the long term giving us very, very mixed signals. So overall bias of the three market timing signals remains with a bullish bias, but an expectation of a lot of sideways chop with small incremental new highs, and that is balanced against periodic test of the low of the range, but nothing is expected to be particularly persistent or in duration or size with this kind of posture until we get something to break out one way or another with this market. In terms of position sizing opinions, they're both still at 100%. Intermediate term market posture, we've had a couple changes here. We're now exceptionally strong bull once again on both the S&P and the NASDAQ. Now that is up against a neutral sentiment line, so again, another indication that we would not expect big new highs nor big new lows unless something new comes into the marketplace. Dow's also in a strong bull, though the Russell deteriorated back to strong bear yesterday. So kind of keep that in mind. It's not a perfect set of signals by any means, in that we still have this kind of weak sentiment line, and we have the Russell kind of going in the opposite direction, albeit this is a first day signal and it's been oscillating back and forth. So again, let's not make too much of this signal. It says strong bear, but it's a pretty weak signal at this point, in that this has been oscillating back and forth. Overall hedge warning status remains 0+, normal with some elevated conditions. The three strategy opinions, again, no changes from yesterday. Mostly comments about this VIX being below the acceptable range to initiate new positions for novice traders, in recognition that the VIX is currently below a 12 and premiums being paid for the amount of risk being taken on is relatively skewed. In terms of areas of specific warning, we've got, the low volatility, expectation that at some point you're going to increase in volatility, while keeping in mind this is a low-grade warning. We can remain low volatility for extended periods of time. Distribution day count on the NASDAQ is stubbornly staying at a 5, but that's a very low level. It's the first level of warning. Skew is in warning status at a 130, about an 11% probability of a 2 standard deviation move in the next 30 days. In terms of trend base, I continue to miss this one, but this weak signal here, this one's actually exceptionally strong bull, and you see the new highs, new lows, nothing of note there. We did have a change in the intermarket risk aversion indicators from yesterday. I saw enough angle and separation to the downside to call all these off of neutral into risk off. It just barely, probably. So these are for the most part still neutral, but we started to see some separation, so we wanted to go ahead and indicate that. We generally try to show warning at the first sign of warning, and then on the flip side, when things improve, we usually try to be a bit conservative on that. So by the very nature of what we're reporting here and reading these indicators, we hope to be relatively conservative and mechanical as much as possible. Leave as much subjectivity out of it as is possible. In terms of sentiment indicators, intermediate term stocks a bit elevated, and overall the fear and greed index, summation of 7 different fear and greed indicators, is coming in at a 56, slightly to the greed side of neutral. Overall performance yesterday, you see essentially a scratch day. Consumer staples, tech, utilities, industrials, healthcare, and telecom all managed to eke out positive days, albeit in almost all those cases relatively minor positive days. None of those over 1%, though have to give a nod to consumer staples, pretty good breadth here, and so forth. In terms of who was not performing yesterday, More notable, energy down over 1%, materials down about 0.8%. The others just basically slightly below scratch. In terms of overall market posture by sector, by time frame, you continue to see, staples. Healthcare has been on the resurgence. We've talked a little bit about that. Financials have been one of the most consistent performers of late. Utilities have been coming back on. Technology's also been quite consistent of late. Those seem to be the best areas of the market for, you're drilling down into your watch list. So kind of keep that in mind. In terms of areas of weakness, retail continues to show really significant weakness, not a lot of sign of support. That's the most notable one to the downside. And then on the percent change, I think, probably here, we've been mostly watching the 1 month because we've been so sideways, looking for a separation from kind of the sideways action. Telecom, of course, has been down pretty hard. Energy has been down pretty hard. And it started to get to the point where it's evaporating much of the 3-month performance. So those certainly have been something to keep an eye on. On the positive side, you have technology up 4% and consistently green across all the different time frames, 3-month almost 11%. So that certainly is of note. Industrials also consistent across all the time frames in the 3-month at 12%, though at the 1 month only just barely above scratch. So not quite as strong as technology. And then, this is also interesting. So the S&P had the big bounce in the post-election period. It's up in the 3-month period, some 10%, and yet in the last 1 month is up less than 1%, albeit, holding on to positives across all those different time frames. So investing in the overall S&P sector, has been productive of late, but probably even better if you are nimble enough and able to reorient yourself to the strongest places in the market. You had a better 3-month performance and you held on to more of that in technology. So kind of keep that in mind. But one of the things that makes this really, really tricky is that we've had so much oscillation. It seems like for a short period of time, you'll have a certain basket of sectors that are strong. And the next thing you know, you look around and, those have flipped to the bottom and others have flipped to the top. And there's not been, as one of the morning authors mentioned, an awful lot of the usual correlations going on of late. I think the biggest picture in the intermediate term is you had the big rebalancing rotation that occurred immediately post-election and persisted for about 3 weeks as the institutions reoriented their holdings in the mutual funds and other places. And then a little bit of overshoot and then rebalancing from that action. And then we've kind of settled now into the sideways action where correlations have been really poor and at the same time, for the most part, haven't achieved much in recent weeks to the positive or to the negative side, with a couple of exceptions, like you see here with energy and telecom, and then perhaps to the positive side, technology, and certainly the NASDAQ has probably been the brightest spot in the broad market indices of late. Okay, I think that's probably enough for today. Remember, as I flip through these slides, you can always hit the pause button if you need more time to review something, or if you want to grab a hyperlink to be able to go to the website and get additional details. Also remember our warning that there'll be no market previews for the next 3 sessions. We'll resume, should be back online with those on Tuesday. We're going to be kind of out of pocket in the backcountry, and that's part of what happens when you live in Montana. You get to play in the backcountry. And disclaimers, as always, hit the pause button if you need more time to read the disclaimers, and then also note the hyperlink down here at the bottom of the slide for the full set of disclosures. Manage that risk profile each and every trading session, and of course, go out there and look to learn something about your trading. In the meantime, good trading to you.